So what are some things that 40-year-olds should consider?
Well, assuming you have the insurance and the emergency savings we talked about in the 30s, 40s is one of the early, first times in your life where your income is really starting to increase. So you have a great opportunity to start maxing out various plans, investing as much as you can. But it can also be a challenge because that's when your kids are often hitting the more expensive club years or whatever else things they're doing and saving for college, et cetera. So there's a lot of conflict in the 40s.
Yeah, it seems like there's conflicts every year, but 40s in particular as the kids get older.
Yeah, absolutely. We both have experienced that.
We have experienced that. So let's go over an example of someone in their 40s. To continue our example, so someone that has $210,000 to start, and let's say their salary now goes up to $110,000, they would need to save $1,375 at a 7% rate of return to end up with $660,000, which would be 6 times. But let's also get more real here. A lot of 40-year-olds don't have much of any savings, so what should they do? So in our second example here, same salary. So in this particular case, this individual is going to have to save a little bit more to try to get caught up. Saving $2,500 a month will end up at 4 times. It's not the 6 times, but at least, Matt, it's better than nothing. But let's talk about that, because I think a lot of people watching this show right now, either themselves or their kids or their grandkids, feel like they're behind. What are some things people can do?
Well, they're certainly not alone. I think if you look at the statistics, most people, especially using those numbers, are behind in those ages. And if you do look, even increasing your savings at that point you still haven't caught up to those people that started in your 30s, so it reinforces the importance of starting back as early as you can. But really, those maximizing contributions, whenever you get a bonus, putting half of that or even all of it into your 401k plan. Every time you get a raise, if you get a 3% raise, increase your 401k contribution by 1%. There are lots of little things you can do that do add up, and compounding is really the name of the game on this. And I use this quote every chance I get from Einstein, which is, compound interest is the most powerful force in the universe.
Yes, but this is hard, right? Because you've been working and you've been sacrificing because maybe you started saving, you have kids, you feel like you haven't really done the vacations, that you want to have great memories. So how does all that factor in?
Balance. That is one of my favorite words in meetings. Yeah, you want to plan, you want to balance living for today with planning for the future. And the problem is if you wait too long, if you spend too much time on the living for now part, then you kind of have to make those sacrifices later to catch up. Because one of the things in your example that you'll notice is that even though that person nearly doubled their monthly savings, they're actually further behind 10 years later. If you look at the math there, they're more than $210,000 behind. So they do have plenty of money. So I'm not trying to discourage anything. Don't ever think that you shouldn't start because you can't get as far, because you can catch up even more later. 50s and 60s, once your kids are out of college. I've seen tremendous number of clients just max out massive amounts of savings in those last 5 to 10 years of employment and really do a lot of catching up. But of course, it's harder to do if you haven't done something a little earlier. So the 40s is a great time to get that really
rolling. And I think that's a good point. I mean, one of the key points here is that it's never too late, really, to improve your situation. But let's go back to your 40s. Of course, another way to look at it is how to, what you're spending money on. Going through your checkbook, seeing what could potentially be cut out. Now, this is painful for a lot of people. So, and some people like to budget, although very few.
That's true.
Maybe a few accountants. But most of us don't like to budget. But how should we look at our expenses?
Well, just about everything we spend money on, there's probably a way of reducing that expense. You could get all the way down to the level of cutting coupons and so on, but let's talk about someone that maybe if you haven't saved a lot, chances are you have some credit card debt, some other kind of debts, things like that, and you've heard, I'm sure most people have heard, about as you pay off the credit cards one by one, you add that payment to the next credit card so you can work your way down. Another way to look at that is that once you've paid off credit card bills, take whatever you were paying in credit cards and put that directly into a savings account of some kind, an investment account, increasing your 401k, and so on. So that can be a really good way to do it.
I think that's a good point, because if you can make this less painful, if you can add to savings when you get a raise or a bonus, if you can figure out some strategies, maybe you pay down some credit cards or you pay down a car loan, you got a little bit more income, apply that to savings, you'll be in a lot better spot.
And something that actually applies very much so today is with the low interest rates and mortgage rates being as low as they are. If you can refinance and save $200 a month on your payment, don't just assume you have $200 more to spend. Immediately use that savings to increase your savings.
Go to yourmoneyyourwealth.com. Make sure that you click on our special offer today. It's cracking the financial code. You can succeed financially at any age.